Gold is weaker this first trading day of spring as the dollar is up. We're looking at gold as a currency play here with our next guest. BK Asset Management's Boris Schlossberg joins us in studio today. Boris, thanks so much for being with us.
My pleasure to be here. Nice
Gold struggling here this first trading day of spring, but we're still up 17% since the start of the year. How do you see gold? Is it still a safe haven play here?
Definitely. I'm a big gold bull this year because gold is really getting a huge benefit out of the fact that all across the world we're now in a negative rate environment. And the single biggest knock on gold has always been that it's a asset that is hard to own because it costs you money to own.
Right.
But now it actually costs you money to own cash. So therefore, gold is really getting a very, very competitive bid because of that.
So what do you do with it at these levels? Is it time to cash in gold? Is it time to be buying gold? What do you do here as an investor?
We're huge believers in buying on pullback. As a matter of fact, it's been really hard to buy gold at this point because it's not really pulling back. Everybody thinks that gold is going to come down below 1,200 an ounce and try to establish positions there. I think it's going to be hard. I think at these levels here, 1225 is probably as good as it's going to get, and then gold is probably going to go higher.
Okay, and what are your thoughts on the U.S. dollar, especially after the last Fed meeting, which was deemed dovish? Where do you see the U.S. dollar here headed?
Well, the dollar definitely got knocked for a loop off the FOMC meeting, and that actually helped gold tremendously, precisely because the Fed appears to be a lot more reticent to raise rates than the market initially thought. And of course, that's one of the things that's really propping gold up to go further and higher. We do think the dollar sell-off is overdone because it's still sort of the best play in a bad neighborhood. And overall, when you look at the U.S. economy relative to all the other G20 economies, it's growing better. And the Fed will have no choice but to raise rates eventually. But it still does not really negate the bullish case for gold because it's not simply an anti-dollar trade. It's really across the world. If you look across the world right now, $7 trillion of sovereign bonds are actually negative yield. And as investors begin to realize, my God, I'm not getting any money for my money, I think they're going to flock much more to gold.
So, Boris, with the divergent central bank policies we're seeing, how much of an impact is this having on the traditional gold versus USD model we're used to?
You know, these days it's almost impossible to create any kind of a model that has historical basis because the central banks have really destroyed a lot of the correlations that we've seen in the past. But the one thing I think stays very true is that gold really does well when real rates are negative. And real rates are certainly very negative all across the world. The fact that you have $7 trillion worth of sovereign debt that is now yielding negative numbers, all of that is going to have a massive impact on investors. When investors at the end of the year begin to realize they're actually getting less money than what they put in, they're going to flock to gold. And you're seeing that already in the gold market. And
gold has been performing well in various currencies. Is there one that's sticking out for you, one that you're really watching here?
Gold against the dollar is doing really well, but we're also bearish euros. We think ultimately the euro is going to have to come down significantly, probably all the way to parity towards the dollar. So if you're making a bet there, that's probably a very good bet, buying gold and euros as well.
Boris, thanks so much for stopping by the studio today.
Thank you.
And thanks for watching this edition of Kitco's Gold Report. We have Peter Hugg up next.